The Central Bank of Ghana today raised the country's key lending rate by 50 basis points to 30% on account of inflation and other economic headwinds. Let's take a listen to Ernest Addison. The BOG governor asked his press briefing a few hours ago where he provided some background to MPC's latest decision.
From the beginning of the year to June 2023, the Bank of Ghana has built up $1 billion in reserves, mainly coming from its gold purchase program and settlement of short-term liabilities. Gross international reserves, excluding encumbered assets and petroleum funds, improved to $2,353.95 million, equivalent to 1.1 months of import cover, compared with $1,440 million, 0.6 months of import cover, recorded at the end of December 2022. The bank's domestic gold purchase program, which was launched in June 2021 with the key objective of shoring up the bank's foreign reserves by purchasing domestically produced gold and converting same into foreign assets. Since inception of the program, a total of 7.73 tons of monetary gold valued at approximately $480 million has been added to reserves under the Gold for Reserves program, well ahead of the target of doubling the gold holdings in 5 years. The foreign exchange market has remained relatively stable for the first 6 months of 2023, supported by positive market sentiments derived from the IMF disbursement of the ECF first tranche of $600 million, forex purchases from mining and oil sectors, and weakened demand. The cedi depreciated by 20.6% against the US dollar in January 2023 and has since remained generally stable, with a cumulative depreciation of 1.8% between February and June 2023. In sum, global growth showed signs of improvement in early 2023, but near-term prospects remain uncertain amid tight financing conditions and elevated underlying inflation. Global financing conditions remain tight in both advanced and emerging market economies, reflecting pass-through effects of aggressive monetary policy tightening on bank funding costs and credit conditions. Headline inflation has continued on a downward trend across many countries, responding to tighter and coordinated monetary policy, easing energy and food prices, and reduced supply bottlenecks, although core inflation has been more persistent amid cost pressures in labor markets. Consequently, the policy stance for most major advanced economies is expected to remain tight until inflation declines to central bank target ranges, with adverse implications for financing conditions for emerging and frontier markets, including Ghana. On the domestic front, the external sector position improved significantly in the first half of the year, bolstered by a current account surplus reflecting higher gold receipts, import compression, and lower investment income payments. The external sector performance, the domestic gold purchase program, along with increased voluntary repatriation by the mining sector and liquidation of some short-term external liabilities, led to some sizable accumulation of external buffers. The outlook for reserve accumulation in the second half of the year remains broadly positive and expected to be boosted by expected inflows from the cocoa syndication and other multilateral inflows from the World Bank and the African Development Bank. Real sector indications somewhat improved, with higher GDP growth recorded in the first half of the year. The CIEA in May showed some gradual recovery, though the index remained in negative territory. Results from the confidence surveys showed some slight softening in consumer sentiments, while business sentiments remained broadly stable. Real private sector credit has come under pressure on the back of tighter lending conditions banks' impaired balance sheets, elevated credit risk, and the observed slowdown in credit demand due to the lingering effects of the macroeconomic downturn from last year. Meanwhile, banks' half-year performance in 2023 shows considerable growth in profits following the significant losses posted in 2022. If this trend continues, we expect banks to rebuild capital buffers quickly, in addition to equity capital injections by shareholders to give a further boost to real sector growth and to build resilience of the banking sector. Early operationalization of the Ghana Financial Stability Fund should also help provide additional recapitalization support for eligible banks in line with the criteria and governance framework agreed with the IMF and the World Bank. Fiscal policy implementation for the first 5 months of the year has been broadly in line with the IMF-supported program. The primary fiscal balance is moving in line with expectations, and government's recourse to central bank financing has been eliminated thus far. Although revenue underperformed over the period, this was countered by a corresponding slowdown in expenditures. In the outlook, remaining vigilant to the risk of financing the budget from resources from short-term financing, end of the market, enhancing revenue mobilization, and aligning expenditures with revenue inflows will be key in forging ahead with fiscal consolidation efforts to help foster credibility, restore confidence, and support the disinflation process and anchor the emerging stability. Implementation of the IMF-supported Extended Credit Facility Program for the first 6 months of 2023 is broadly in line with the performance criteria targets for June 2023. While the program envisaged a drawdown in reserves of the Bank of Ghana of close to $100 million, the Bank of Ghana built reserves in excess of $1 billion. Bank of Ghana financing of the budget under the program is expected to be zero, and this has been met. Regarding the monetary policy consultation clause, inflation as of June 2023 was within the target band. After declining consistently between January to April, headline inflation increased in May and June on account of a variety of factors, including higher food prices, implementation of new tax measures, and utility tariff adjustments. Overall, inflation increased from 41.2% in April to 42.2% in May, and then further to 42.5% in June. Underlying measures of inflation have all ticked up in May 2023. While core inflation ticked up, business expectations of inflation remain flat at an elevated level. Although inflation is expected to decline in the near term, baseline forecasts show a slightly higher elevated profile in the year ahead, which, if not contained, could embed in underlying inflationary pressures. It is important that policy responds appropriately and decisively to prevent these risks from becoming embedded and consequently derail the disinflation process. In the committee's assessment, risks to the inflation profile are judged to be elevated, driven by second-round effects of food prices. Inflation has persistently hovered around 42% throughout the second quarter of 2023, even though central bank financing has been eliminated in the first 6 months of the year. Ghana's macroeconomic framework requires decisive tightening from both the fiscal and monetary side to anchor inflation expectations firmly on the declining path. Given these considerations and under the current circumstances, the committee has decided to increase the monetary policy rate by 0.5% to 30%. In the coming months, the committee will monitor closely incoming inflation data and will respond appropriately if needed should inflation persist.